So I've added a new column here on the price ladder, which is called the VAP, the volume at price. So assessing the bids and the offers. As we mentioned, these may be false orders, they may be real orders. We don't know. All we know is that there are orders currently in the market willing to trade. The key piece of information is the VAP, the volume at price, because what we can actually see from that is how much volume has actually been traded throughout the course of the day. This typically resets every day anyway. But you can see sort of the curves, the peaks, the valleys, things like that. And normally, what we like to see, the market's job is to facilitate two-way trade. So areas that have been traded, such as these areas, generally hold some sort of significance in what the price is going to be doing. We have, as you can see, we do have tails that we like to refer to them as tails on the extremes um, of low liquidity or low volume areas in the market. You can see here we've got a few bumps, a uh, few larger bumps slightly further down here. You need to remember, of course, a lot of this is synthetic at the moment because it's me playing around trading the bids and the offers at will. So we are going to get some misprints. However, the areas that we like to look for, I mean, it's fairly consistent at the moment on cable with the volume that we've traded. Might just be worth looking at the S&P, maybe not, or maybe WTI. No, see at the moment they're all fairly consistent. We've got quite a nice arch, if you like, throughout each price. What normally would happen is when we have a large price movement um, in a very quick uh, quick arrangement. So something like this. This is just still the 1 minute time frame of the of cable, British pound. Something like this, where we have bang bang bang, and something like this, bang bang bang. Here we have the three sharp, quite aggressive move candles up, and the same here as well. We have quite an aggressive move up here. This is essentially, as we discussed, the grabbing of liquidity. So the buyers are filling orders and they're aggressively grabbing the sell side liquidity. And if the sell side liquidity is thin or there's not much of it, obviously these moves will be exaggerated higher and higher and higher. That was what we discussed in the previous video. So what does that actually mean for the market as a whole? So as I said, the market is the market makers and the market sort of mechanics isn't to hurt anyone or to stop anyone out and take anyone's money. That's not the purpose. The purpose is to just facilitate two-way trade. So if I'm a buyer and you're a seller, we can trade at an agreed price because of the market makers and the market mechanics. That's what the market is there for us to do. It allows banks. It's part of our modern economic system. Without them, obviously, we wouldn't have an economic system. It allows the banks and the countries and governments and whoever may need to execute orders with one another to hedge, to physically buy or to physically sell, whatever it may be. But that is the core basic of why a market is there to facilitate the trade between buyers and sellers. So when we have these large moves higher or lower, it can be any direction. Um, and we have the grabbing of the liquidity, the reaching for low liquidity. What we're actually leaving is the VAP is a very low or volume traded at the price is extremely low. So if we quickly move from, let's just create a quick scenario. So we're going to move the market down just a few, prices here. There we go. I'm going to cancel it. So what we have here is a large move down in quite a quick succession. Yes, it was falsified. There was nothing real behind it. It was all just simulated. But what we've now done is prevent the market from facilitating trade at these prices. So if I just get the pencil tool here, the market probably will move back fairly soon because my orders will be filled. But here, in this whole area, it's been very one-sided trade. It's been me. There's only been me selling in that particular market, and it wasn't filled or traded fairly because what we've done is move very quickly away uh, from a particular price where everything started. We've moved very quickly away from here, traded down, and anyone that wanted to trade, so banks, governments, hedge funds, institutions, whoever wanted to trade at these prices prior to this green wick here, wasn't able to do so because the price moved too quickly for anyone to either buy or sell. It was just me selling and the whatever remaining liquidity there was in the market being the recipient on the buy side. So when we leave these uh, sort of overextended price points, we can refer to those as unfair auctions because it hasn't been fairly traded. So by seeing this, it's the market maker's role as a sentence to facilitate this trade at this unfair price. So if we look at real-time data of what's actually happened here, this is obviously 1 minute time frame. It's very small, very focused in on specific prices. If we just look at this example here, we have buyers reaching for liquidity. Buyers are grabbing the sell side liquidity, pushing the price higher by filling orders. Whatever their intention is at the end of this, they are pushing price higher. We then see this, obviously, where the price is happy to trade. So we've had a slight reprice for whatever reason, filling orders, repricing, institutions dealing. It could be whatever. Um, we have the order filling process up here as well. So we have a happy area in price, should we say, where two-way trade can occur. We have down moves, up moves, down. This may seem like a waste of time. It may seem slow or boring, or we may be sitting with a short position here, waiting for the market to move, and it could just seem like forever that we're not moving until we finally see a slight pop here. But that's normal because we have trade facilitated up here. It's the market makers facilitating trade at higher prices. What we then see is, or what we need to consider is, we still have this area here which has been unfairly traded. We have an unfair auction here because the buyers were grabbing sell side liquidity aggressively, forcing price higher, meaning that the market makers have to allow a price to trade back down at these areas to allow anyone that didn't get the chance to trade. And what this looks like on the on the volume at price on the price ladder, we can get various studies as well for the volume at price for the charts. It all tells us the same thing. But what we have is something that looks like this. We have unfairly traded prices. We have large tails either side of the curve here, or we may see a curve that looks more like this, for example, where we have unfair prices here, and obviously completing the fair auctions. Because as I say, the market makers aren't out to get anyone. They're not there to harm or to to screw anyone over. Their job is to facilitate two-way trade and then to re-deliver the price into the open market. And it just so happens that by redelivering price into the open market, you will hit stop losses. You will have orders being filled at highs and orders being filled at lows. That's part of the market. Everyone is a willing participant. There's no illegality behind anything. If you have an order in the market to buy up here where the high is, you're a willing buyer at this price. Whether or not the market traded higher or lower, your decision to buy here was solely yours. You weren't coaxed into doing anything. Um, the fact that you would have taken a loss or would be running at a loss is your problem, so to speak. So markets are there simply for buyers and sellers to carry out